In this chapter, we're going to be looking exclusively at aggregate expenditures in the economy. So you'll recall in the last chapter, we were introduced to the concept of aggregate expenditures using an aggregate demand and aggregate supply model. So remember that we had a graph that looked like this, where we had price level on this axis, real GDP on this axis, and then we had a downward sloping aggregate demand curve. And we basically said that the amount of aggregate expenditures that were going to take place in the economy was dependent upon what the price level was. In other words, if the price level was here, then this would be the level of aggregate expenditures that took place. In other words, all aggregate expenditures is the sum of the consumption spending, the investment spending, the government spending, and then the value of our net exports. But again, we were taking into account those price level effects, how when the wealth effect, interest rate effect, and international trade effect were, changing, that's what was causing aggregate expenditures to change, because we would be moving up and down this aggregate demand curve. In this chapter, we're going to use what's called a fixed price Keynesian model, opposed to dealing with price level changes. Here is what a fixed price Keynesian model looks like. In other words, we still have a downward sloping aggregate demand curve. However, notice that our aggregate supply curve right here is a completely horizontal line, which basically means that the price level is not changing. We don't have to deal with price level effects. This would be an important model to use if you have an assumption that you have a lot of excess resources and high unemployment rates in the economy. So think about an economy that is in a recession or just coming out of a recession. The idea is that even if there's an increase in demand for goods and services in the economy, it's not necessarily going to put pressure on the price to go up, because firms are able to pull from all of their excess resources and abundance of workers because of the high unemployment rates that currently are taking place. So again, this is going to allow us to examine in more detail the demand side of the economy. In other words, focus exclusively on what shifts that aggregate demand curve. Now, we can understand what determines real GDP in the economy if we understand all of the different components of aggregate demand. So we're going to begin our detailed examination of aggregate expenditures by discussing the four different components, or again, determinants of aggregate demand. The first one that we want to look at, which is probably the most important, is the consumption expenditures. In other words, what are the factors that determine the different levels of consumption in the economy? Now think about your income. In other words, consumption is just the amount of money that we spend on goods and services in the economy. So of course, in order for consumption to take place, there has to be income. Now, there's only three things you can really do with your income. You can either spend it, which again we define as consumption expenditures, or you can save it, put it in the bank, put it in your piggy bank, what have you, or of course you can pay your taxes with it. Now, disposable income is what you have left over after you've already paid your taxes. So the way that we look at disposable income is using this formula right here. In other words, after you've paid your taxes, then technically there's only two things you can do with your money, which is either spend it or save it. So disposable income is always going to equal consumption plus saving. In other words, any money that you're not spending, you're saving, and any money that you're saving, you are consuming with or spending. Of course, we can then rewrite that formula. What if I wanted you to solve for consumption? Well, then consumption is just going to equal disposable income minus savings. Or if I wanted you to solve for saving, you would just take disposable income and subtract consumption. So again, all of these formulas are the same thing, just showing you the fact that consumption plus savings equals disposable income. Now, of course, any money that you are saving is not going to be going towards consumption expenditures. In other words, saving is not consuming, so it's not a component of total spending in the economy. If you go and buy a U.S. Treasury bond, that's not actually spending money on a good or service. All you're doing is taking your money and putting it in another form of money. So we want to make sure that any money that you are saving that is not buying a good or service does not go towards total spending in the economy. Another thing that we want to distinguish when we're looking at saving in the economy is making sure that we understand there's a difference between saving and savings, which can be a little bit confusing sometimes. Saving is what we call a flow concept. In other words, a flow concept is something that can change over time. So in other words, think of something like GDP. GDP is not constant. Every year GDP can change, so therefore GDP is considered a flow concept. So again, saving, let's say every single month I save money. That's a flow concept. Whereas if I'm talking about savings right here, savings is a stock concept. In other words, if I say right now I have $1,000 in my savings account, that's telling me the amount of money I've accumulated at a specific point in time. So again, saving and savings are two different terms. One of them is a flow concept and one of them is a stock concept. So generally when we're talking about saving, in terms of our formula that we just learned, in other words, where I said disposable income equals consumption plus saving, this term right here, this is referring to this right here. In other words, the flow concept, the idea that every month, you get your check and you can spend a certain amount of it and save a certain amount. That can change from month to month. So it's a flow concept. Whereas savings down here, that is actually going to be a component of your wealth. That is not consumption expenditures. In other words, the amount of financial capital that you have accumulated right now, that would be your saving. So that's a wealth concept. Where saving, that's a component of your disposable income. So now that we've defined the fact that the level of that households spend and save is dependent upon their disposable income, we can look at what's called a consumption function or a savings function. So what we're looking at first is a consumption function. And all a consumption function is going to show the relationship that exists between the level of disposable income and the amount of money that we're actually spending. In other words, consumption. Now, of course, we know that the level of disposable income that households have is the primary determinant of the level of consumption over any given period of time. In other words, think about yourself in terms of your day-to-day spending. You know that the amount of money that you make, your paycheck, is the most important factor in determining how much money you actually go out and spend. So that's why we look at consumption as a function of disposable income. What we believe is that the higher your disposable income is, in other words, the more money you make, the more you're going to be willing to spend. So notice up here, I've drawn a little hypothetical schedule where I'm showing the different levels of consumption that will take place depending on what my level of disposable income is. So notice that even when my disposable income is zero, I'm still going to have some consumption expenditure. So let's say, for example, I didn't go to work at all this month, so I don't get a paycheck, so my disposable income is zero. We can see based on this little schedule that I'm still going to spend approximately $50. Then let's say my disposable income increases. Let's say I do go to work and I make $100. Notice that my consumption then increases. Instead of only spending $50, I'm now spending $125. Again, if my income goes up again, if I make $200, my consumption increases to $200, so on and so forth. So again, what we're seeing is that there's that positive relationship. As my disposable income increased, my consumption expenditures increased also. And then, of course, what we normally do with that information is graph the consumption function. So in other words, that's what I'll do right down here. What we have over here on this axis is consumption, and what we have on this axis is disposable income, and we want to look at the relationship between consumption and disposable income. Now, normally the first thing that we do is draw a 45-degree line, and so in other words, the 45-degree line is going to show you all the points that consumption actually equals disposable income. So in other words, if I was actually spending all the money that I made, then I would be along that 45-degree line. So in other words, if I plot these points right here and then connect them, that's what's going to give me that 45-degree line. In other words, again, all it's showing is that if I make $100, I spend $100. If I make $200, I spend $200. And then what I can do is graph my actual consumption function. So in other words, it says that when disposable income was zero, I forgot to put the zero right here, when disposable income was zero, my actual level of consumption was $50. So in other words, my first point for my consumption function would be right here at $50. Then it shows that once my disposable income went up to 100, my consumption was actually 125. So in other words, I come up here to about 125, and then I would plot that point as my second point, so about right there. Then it shows that when disposable income was 200, my consumption was 200. So now I'm actually going to be intersecting that 45-degree line. And then when disposable income was 300, consumption was 275. So let me write 275 in here and then come across something like this. And of course now I can connect those dots, and that will give me my actual consumption function. So again, the black line, the 45-degree line, that's actually showing all the points where consumption actually would equal disposable income, whereas the red line, and I realize it's a little sloppy here, we'll look at some examples in a second that don't look so sloppy, that's my actual consumption function. That's showing the actual amount of money that I'm spending depending upon my level of disposable income. Now here is the U.S. consumption function, U.S. consumption and disposable income from 1947 to 2002. So this is actually taken from the textbook showing the long-run consumption in the United States. So again, you'll notice that the graph has the 45-degree line drawn on there, which shows all the points where disposable income and consumption would be equal, and then the blue line represents the actual consumption function, which is just below the 45-degree line. So again, what that is showing us is that the amount of money that we're spending is not really that much less than disposable income. So the area in between the black line and the blue line, in other words, any area right in here where you see, pen's not drawing here, but anyways, the space in between the black line and the blue line, that would represent any money that we are actually saving. So the closer your consumption function is to the 45-degree line, the smaller the amount that everybody is saving. Whereas that consumption function gets further away from that 45-degree line and remains below it, then that means you're having a positive savings rate in the long run. Now here we have a hypothetical consumption function taken from the textbook. So again, this is much nicer and neater than the one I drew for you. But again, it's basically giving you the same information. In other words, this first column of data right here, this is showing all the different levels of disposable income that could occur. So we start at 0 and go up to 700. The second column of data is showing us what the actual level of consumption is depending on what the level of disposable income is. And then, of course, notice that we also have a third column of data, because remember I said any money that you're not spending, you have to be saving. So in other words, notice that for each row, the consumption plus the saving equals the disposable income. Again, going back to our first formula, disposable income equals consumption plus saving. So again, notice that when disposable income was 0, consumption was 30, therefore savings had to be negative 30. When disposable income was 100, we see consumption is 100, therefore savings had to be 0. In other words, so again, for each one of these rows, doesn't matter which one you're looking at, when you look at the consumption plus the saving and add them together, you get disposable income. And then, of course, what we did is we took the data that was in our consumption column and then graphed our consumption function over here. So in other words, the 45-degree line represents all the points where consumption would actually equal disposable income, and then the pink line represents the actual amount of consumption that's taking place. Again, notice that the consumption function has a positive slope, which means that the amount of money that we spend is positively related to the amount of money that we make, which is the same thing as saying the more money you make, the more money you're going to spend. Now, again, the area in between the 45-degree line and the pink line, that represents savings. So all of that yellow shaded area at points above disposable income of $100, we have a positive savings rate. However, notice that we do have a small portion of dissaving anytime our disposable income was less than $100. So that was down here. In other words, notice, and again, we see this on our schedule, when my disposable income was 0, it says that I was still spending $30, which means I had to be going into my saving to fund those expenditures because I didn't have any income. So how else would I be able to spend $30 unless I was taking it from some form of saving that I already had? So that's why at any point below disposable income of $100, we actually have a negative saving rate. And then once we intersect that 45-degree line, which again in this graph is at $100, that's when we move into having a positive saving rate. Now here we're looking at a graph that has the same, or a slide that has the same exact table that we saw on the previous slide. In other words, we still have our column of data for disposable income, we have our second column of data for consumption, we have our third column of data for saving, but now rather than graphing the consumption on the graph, we are graphing the saving on the graph. So this is what we call our saving function. We're graphing saving as a function of disposable income so that we can see how much we save in relation to how much money we make. And again, notice that our saving function also has a positive slope. In other words, again, the more money we make, the more money we are able to save. So this is showing us exactly what we were already kind of looking at on the previous graph, but now we're just looking at saving as a function of disposable income. So again, here we see that we have a certain level of dissaving. Notice that at any point that our income was less than $100, that's when we were in a state of dissaving. So that's what we see over here. Once we make $100, we spend $100, that's where savings is 0. So that's our intercept right there, this point right here. And then once our income is past $100, that's when we have a positive savings rate. So that's what we're looking at right here. So the yellow shaded area beneath the blue saving function is all our level of saving. But again, our consumption function and our savings function both have positive slopes because as we make more money, we are able to spend more money and we're able to save more money. Now, as I stated before, consumption and saving are positive functions of disposable income. That's why we have positive slopes when we graph them. So the more money you make, the more money you spend, the more money you save. And then, of course, when households spend more than they earn, that means you have to go into a state of dissaving. So in other words, in our previous example, at any income levels that were less than $100, we were in a state of dissaving. saving. Now, if we're spending money that is not dependent upon the amount of money that we make, we call that autonomous consumption. In other words, any time that disposable income is zero, but you're still spending money, what that means is that that amount of expenditures must have nothing to do with the amount of money that you make. In other words, you're spending that even with no income. So that's why we call it autonomous, because it's not dependent upon the amount of money that you make. So in the previous example, our autonomous consumption was $30. If we go back and we look at this right here, all you have to do to know what the level of autonomous consumption is look to see when disposable income is zero and see what your level of consumption is. So we can clearly see that right here, when income is zero, consumption still equaled $30, which means that is the level of your autonomous consumption, the amount of money that you spend that has nothing to do with how much money you make or your income. So if we want to know the total level of consumption that is taking place in the economy, all that we have to do is add up autonomous consumption plus the amount of expenditures that do depend on income. And again, total consumption will rise as disposable income rises.